Yeah, things outperform massively. It's up 2.5 times the Nasdaq year to date. So we think there's going to be some divergence given the outperformance. And you mentioned Facebook at the breach when they had the unfortunate incident. The stock was 150 and then ran 35%. So we think this is simple profit taking. These are great franchises. We still have over 10% upside to many of the names in the internet space, and we're still recommending investors stick with those big pillars. We don't see any fundamental challenges ahead. Really, valuations the biggest concern, and we like Google here a lot given the valuation support at 12 times EBITDA, and you got 4 call options inside their business beyond the ad business that could kick in over the next several years.
Yeah, and Jeff, we're coming up on this major milestone tomorrow, depending on who you speak to, the longest ever bull run in history. Tech's been a big part of that move, I think, since 2009. Tech sector has contributed 22% to the gain in the S&P. Does that continue?
We think that maybe it's time for tech to take a little bit of a breather. In fact, we just went to a market weight in tech from an overweight that we'd held for 8 years. We just did that last week. And the reason isn't microeconomic. It's not really about the fundamentals of the companies. It's about slowing global economic momentum. Those companies more dependent upon continued acceleration in growth. Again, it's not about no growth. Growth is just slowing. We may have seen the peak for the global economic cycle already, and that means areas like technology, very sensitive to the pace of growth, may begin to lag a little bit. So going to a neutral weighting in tech after an 8-year overweight.
So Brent, we were talking about Netflix being down, but I mean, it's still, if you look at year to date, it's still outperforming pretty much all the others. How much of this is a valuation issue, perhaps, and perhaps people feeling a little bit more comfortable with fundamental value?
Our media analyst covers Netflix. I cover the big internet names, but I think just look around, and my kids just consume Netflix and Fortnite. That's all they're consuming at home, in addition to hopefully doing their homework. So, those are the 2 primary platforms I'm seeing young kids and effectively what's happening where time is being spent on entertainment. And I think the ad-related names, Facebook and Google, have lagged, right? The subscription names like Netflix and to some degree Amazon with Prime have thrived. So you're seeing, I think, a lot of institutional pushback around these ad-funded models. And they've again, there's a common correlation what's happened with the subscription models doing very well. Look at names like Salesforce.com, Adobe. The subscription names are thriving right now.